if you want an update of the 2025 year, I did that in the MIF in January, so I'm not going to do that again. And I'm not going to talk about the market. I'm going to talk about the reaction to the market by some big moves in the sector that we cover in the letter. So we'll start with this unlocking of supposed value. Okay, so Barrick underperformed its peer group. So the gold line is the GDX, which you benchmark to major gold producers. They slightly underperformed the Barrick New York Stock Exchange, but they very underperformed their arch nemesis, which is Newmont. And that's problematic. The reasons are poor operational performance, elevated geopolitical risk of its operating and development assets, especially in West Africa, and then its switch in strategic focus to copper in terms of growth, whether that was in problematic Balochistan and Pakistan with Reko Diq. Lumwana problematically is not problematic in Zambia, but it is copper, and doing all of that in a rising gold price environment. So if you were looking for leverage to gold, investors weren't thinking that you were getting better off going to Newmont. And so here is a graphic on production. So it's ounces in thousands of ounces on your left. And then it is all-in sustaining costs, and that's the line. The bars are by region. So North America, followed by Africa, Latin America, Australasia, and other, which I'm not sure where that is. So the biggest decline was Latin America, and that was declining at a rate of about 10%. And, from when I was going down to Chile and I was seeing Barrick closing offices in Chile and sort of retreating. And also, their mines like Lagunas Norte was coming down. Parina's obviously been closed for a while, but they weren't reinvesting, it didn't seem, in South America. South America or Latin America includes Pueblo Viejo, which is Dominican Republic. Australasia was a smaller part of the production, but it declined at about 18% year on year. For that 12-year period from 2014 to 2025. North America, the biggest volume, declined by 1.4% per year. So everything in decline. Specifically, the Nevada Gold Mine joint venture, which they own 61.5% of, and they were operating, that was declining by 3%, while its all-in sustaining cost was increasing by 11%. And that's the argument Newmont is making right now, is that these guys aren't great operators. Africa, on the other hand, grew, and that was the concern. But when I say 5% per year, this includes 2025, when one of their major mines was actually suspended. So if we take it from 2024, the growth would have been higher. But you can see the all-in sustaining cost, went down as soon as they included the NGM joint venture, and then it's been escalating ever since. IPO. So Barrick, last I looked, might have changed, just like everything changed constantly, at a market cap of about $80 billion. So these bankers are valuing the spin out, which would be North America, including Dominican Republic, which is not North America, but it is for them. And it would include their 100% of 4 Mile. And 4 Mile is, an incredible deposit of over 15 million ounces indicated and inferred at over a half an ounce per ton. It's unbelievable, but it's also 100% them. It's not part of the NGM joint venture. So to unlock the value of these lower geopolitical risk assets, the idea is to IPO this by itself. Keep Barrick with everything else, which would be Zambia, West Africa, Tanzania, and Pakistan. But Barrick apparently will retain a significant interest, but we don't know what that is. If they have too big of an interest, then the likelihood of an M&A might be less. So this is a significant transaction that happened over the last week or so. So Antamina is a big copper zinc mine that started probably in the 2000s, 4,200, 4,300 meters above sea level, which is not high for the Andes. And at the end of 2015, bit of a historical context, they had about 205 million ounces of silver reserves. So as we know, most of the silver is produced as byproduct from base metal mines. This is a very good example. And when I worked at Phelps Dodge and I used to trade, I used to buy puts all the time for Candelaria because we produced gold. We did not care about the gold. So we would flatline the gold price as long as we got the byproduct credit. Anything that's less than 10% revenue, you consider byproduct. It does not drive the mine plan. Silver does not drive their mine plan. But they're still sitting on 205 million ounces of reserves. But they're also expanding, need capital. So Glencore sells their stake, 33.75%, and they're the operators. They sold their silver production in a stream to, which was known as Silver Wheaton at the time, which is now Wheaton Precious. They spent $900 million up front, and then they would pay them 20% of the silver price going forward. That was that transaction in 2015 when the silver price was different. So from 2015 to 2025, this is the silver produced on a 100% basis from Antamina. The gray is the stream that would have gone to WPM, Wheaton. So the data here is from S&P Global Market Intelligence, and I just took 33.75% of that silver production. The silver price is just the average annual silver price. So since 2015, Antamina produced on average about 16 million ounces of silver. So it's 175 million ounces theoretically that went to WPM over that period of time. Glencore, they would have developed 54.6 million ounces to WPM, which is 54.6 of the 175, which is 33.75%. Up until 2024, silver price was averaging about $20 an ounce, but then it doubled in 2025. Went from 20 to 40, and so now it's trading obviously higher than that. So in terms of a revenue basis, they made a lot more money. So on a before tax basis, just taking that production, which is 33.75%, multiplying it by the average price of that year, only 80% of it, because the other 20% they have to pay to the company. This is what the payback looks like. So they're still within their 33.75% because they get 33.75% for up to 140 million ounces. They haven't hit that yet. But you can see, like, the tenure of this stream goes not to infinity, but it can go for a long time. When you get past 144 million ounces, it drops to 22.5 million ounces. So the payback is long, but the leverage it provides when you have those years where you have a spike in the silver price, over that first, 2016 to 2024, it was averaging $85 million a year of cash flow. And then it spikes to twice that, $170 million in 2025. So this is the kind of thing these guys are looking for, unadulterated leverage. So fast forward, at the end of 2025, Antamina still had about 195 million ounces of silver reserves. Silver prices are about 5 times higher than they were at 2015 when they closed the first transaction. So now WPM is paying $4.3 billion. They paid $900 million. They're paying almost 5 times as much, which makes absolute sense. For almost the same transaction, the only difference is the 33.75% only lasts for 100 million ounces, not 140. But everything else is the same. So the big takeaway is, silver is a byproduct. Antamina is a huge copper zinc mine. The silver doesn't drive any of the mine plan, not a valuation driver. It's an inexpensive form of financing for the producer, even a big one like Glencore or BHP. And it gives WPM leverage to the metal that they want, which in this case is silver. So when you're worried about silver because there's so much byproduct, this is leverage to that part of the market. So El Dorado. So this was caught me by surprise, this one. So Eldorado was doing very well, just like a lot of gold companies. And they were showing growth. So, majors can't show growth. They're mostly running to stand still, but intermediates can show growth. So they had 3 projects that were they're building: Skouries, Olympias, Extension, and Parama Hill, which actually was a Newmont project when I worked for Newmont that we sold to a little company that Eldorado ended up buying. And that was at the end of 2000. So it's been sitting in their portfolio for about 15 years. And that's why we sold it, because we didn't think it would ever happen. It may happen. But that's one of their development projects. So they have 3 development projects, growth, and then they announced a $2.8 billion share and cash acquisition of Foran Mining. And what it sort of tells me is that, their Greek-focused organic growth profile doesn't seem to be enough for them or potentially for their investors. They probably want a little bit diversification geopolitically. They couldn't find something of value on the gold side, so they bought a base metal thing, which this is, a copper mine underground. But Foran lagged Eldorado in 2025. And why? Because it's an underground project. When they got underground, trying to get close to commercial production, they blew out their capital again, and they had to raise money, $350 million. And so that's what kept Foran back. Foran, I believe, is one of those major project office selected projects as well. So it also get benefits from the Canadian government investment. Their growth fund, I think, is in this. But interestingly, just point this out, both of them went down after the announcement. Why? So I've talked to shareholders of both. One of them would say, if they were a Foran shareholder, you screwed up. Are we recording this? Yeah, okay. You did something naughty, and we paid for it, but now you're getting into commercial production, and so now the share price should come back. Why are you selling now? For Eldorado, it says, what are you doing? It's Eldorado Gold. And so that would have been on that side. So the thesis behind the transaction for both the boards did not match what the investors wanted. They're still targeting commercial production. And so Eldorado, heavy capital, human resources, construction commitments, and then they go for McIlvany, fully funded now, hopefully permitted, low execution risk, close to commercial production, top tier jurisdiction, which they can't really say about Greece. It's small. It's not big, 30 million tons, 1.2%, all underground. So what is the implication of that for me is that copper and base metal projects resemble gold projects technically. Mining method, processing. And I'm sure some of these projects that they have base metals in them as well in Greece. The project size isn't meaningful. It's not big, but this is an intermediate company, but it's high grade. And it sort of puts into mind for me that these lower tonnage, you don't need 1 billion tons of low grade to excite the market. Foran has showed that smaller tonnage, high grade can get a lot of momentum in the market. And so if you're thinking about playing copper, you don't necessarily need to go big or go home. Canada remains a priority. So if you want geopolitical diversification, and I'll show you another example, Canada seems to be a choice. Low takeover premiums. This is also something important, is management is so important, because if the M&A is all about you have to get it permitted, you have to get it built, and you have to get it into production, then you need all those people in that management team. You can't wing it with a bunch of guys that can only do a resource estimate. So you got to watch management if you're going to take it from soup to nuts. Not everybody can do that. But that seems to be where these guys are willing to pay a premium on once it's in production. They don't want to take the capital risk. They don't want to take the permitting risk. They don't want to take the development risk. So refinancing. So Equinox, this is their balance sheet. Working capital-wise, positive. They had about $600 million of positive working capital, but they were also carrying about So about $1.4 billion of debt, long-term debt. But it was the cost of that debt more so than the volume of the debt. And so they had a lot of high cost financing. And so this represents about 775 million in long-term debt. And this range, effective interest rate, EIR, from 8.7% to 17.4%. They wanted to get rid of that. And if you sell to the Chinese, you get cash. You don't get shares. And so they got 900 million of that billion upfront in cash. That took that out. So in this kind of market, you sell into it if you can. So here's a Brazilian portfolio to CMOC, Chinese state-owned enterprise, for $1.9 billion upfront. And they're focused on Canada. Again, Canada. So 63% going forward now is all Canada. And now they don't have that high cost debt anymore. Lastly, diversification. Again, Canada, Orezone operates the Bombori oxide open pit mine in central Burkina Faso, West Africa. But they had plans to do a 2.5 million ton per year sulfide plant as they went deeper in the open pits. They have a lot of shallow oxide, but it's typical of West Africa. Once you get into the hard material, you're going to need more power, mills, and that. And then they wanted to expand again to 5.5 million tons to show growth. But underlying that is what's happening to West Africa resources. So the Burkinabe government is now trying to increase their carry on these assets from 10 to 15% to 25%. So you don't want to invest in a growth project when now you're going to get 75%. So they had $14 million of working capital in Q3 2025. They drained about $55 million of free cash flow because they were building the 2.5 million ton per year plant. They were 80% through with that. Dual listed now because they wanted that premium that the Australians were giving to West Africa that the North Americans weren't. They raised $75 million there. But now they announced that they bought Casa Berardi, open pit, underground, 3,500 ton per day operation, gold mine, produces about 95,000 ounces a year, 1,850 to 2,000 all-in sustaining costs from Hecla. So the purchase in total, $593 million, but it's complicated. $160 million in cash, which they don't have, 112 million shares, which they do have, deferred another $80 million, and then contingent payments based on production, another $241 million. So backing this up is actually $100 million of a stream by Franco-Nevada. So you can see the difference with Franco-Nevada doing a lot of these smaller things and Wheaton going for the big one. And it's probably the big one is lower risk because Antamina is already operating. It's been operating for a long time. You got a major actually running it, and you're going to get the silver stream off of it. This is still going to be a development project, and Orezone has to get all the other money to make sure that they can build it. Continue it. Sorry, it's already in operation. All right, so I got 52 seconds. Okay, Barrick. Underpin poor operational performance, want to split the company. It's most of their valuation is the company that's actually being IPO'd and not the company that's staying. Streaming transactions on a byproduct is a win-win situation for both. Cheap form of financing for something that doesn't matter to the major, and for them, they get pure leverage to a metal. Lower risk because it's operating, lower risk because it's a major that's doing it. They're paying more for it. They're paying 5 times more for it than they did last time, but they're expecting silver price to keep going up. And I showed you the payback. Okay, read this at your leisure.